All right, so welcome you all once again to Target Professional Consults. We are going to look out for IAS 10. We got that one already. IAS 12, tax, income tax. This is one of the important section or important IFRS or a standard that we need in preparation and presenting financials. Bomish, the income tax, anywhere, anything about tax in our report, in our financial statement, how do we go by it? So can you join us as we go in a bit deeper to see how accountants we can calculate our taxes, how accountants we can record and measure taxes. That is all about taxes. The main central focus is on deferred taxes. That's the one that is creating a whole lot of issue to the extent that exactly last two sittings, ICA Ghana level 2 had a deferred tax. The same question again, or the same standard. Final level 3, also have deferred tax. So it tells you clearly that you must get taxation very well. Now, let's get something clear that IAS 12, it basically is an accounting measure. And I'll explain why I always make that statement that IAS 12 is an accounting measure. Good. All right, so let's go straight to the board. IAS 12. Income tax or accounting for taxes. Please, this is an accounting measure, not a legal measure. So take note. This is an accounting, but not legal measure. Why do I always say this? All what it means is that it only exists in accounting books. You can only apply IAS 12. Only accountant can apply it. Legal by country laws. Tax of an entity is not in the hands of the accountant, not even the IAS 12. The actual taxes is in the hands of the tax authorities using the local laws. Using what? The local laws. So take notice of that. So whatever we are learning here exists only when accountant is preparing financials. But when tax man is also determining his tax, usually something different. So this is not a legal measure. Instead, it's an accounting measure, something used by accountant alone, not the tax authority. So take notice of that. Now let's go straight to the main issues in the IAS 12. Now, income tax of an entity is made up of three things. So the income tax expense you see in the entity's profit and loss statement is made up of, so income tax expense made up of three things. I normally call it C, U, or O, and D. The only three things. As soon as you understand these three things, we are done with IAS 12. However, As soon as we are done with these three things, we are done with IAS 12. However, an attempt to explain each of them will cause a lot of issues. So you must know them. Yes. So first thing, IAS 12 specifically deal with three issues. So as soon as the first one is called current tax provision, the C. We also call it corporate tax provision. The U is called under or over tax provision. And then the very last one is called movement in deferred tax. Deferred tax movement. That's all. Under you add, over is subtract. So at the end of the day, this is the income tax expense. So call it CAT as an acronym to make learning very easy. Wow. Okay. To make learning very easy, call it CAT. To make learning easy, call it CAT. All right. Now let's go straight to the game. So I'm going to take my time and explain to you each of this, how we can obtain them, their recognition, their measurements, and that is all. As soon as I'm done with these three, IAS 12, we are done. So IAS 12, IAS 12, income tax, only three things you must know over there. How do we obtain the current year tax? How do we obtain the under or over? Finally, how do you obtain the deferred tax movement? We are done with the game. When you get these three things, when you sleep, sleep walk. And when I'm done, I'll project and show you the same question, which was the same standard, which came in ICA level 2 tax and the final level tax. And then you do the judgment, the mathematics for me. Now let's go straight and pick the very first out of the three. In fact, it is the first two are the easiest of all. The challenge is the last one, the deferred tax. So please, when I get there, get everything clear. Good. Because if you don't understand it, I will not also understand why you don't understand. So let's go. Current year tax. Current year tax provision. This is the tax provided on the profit before tax. This is a tax provided on the current year profits. So the tax provided on what? The current year profit. Tax provided on current year's profit. It's a provision. Current year profit before tax. Full stop. It is calculated by multiplying the marginal tax rate of the entity. It is calculated. So accountant, in reality, you calculate it by multiplying the current tax rate or current marginal tax rate by the profit before tax. That's it. The entries are 1, 2 accounts. You add to tax expense. Indirectly, you are debiting P&L or you are debiting income tax expense. Last one, you always add it to current liability. You are crediting liabilities on the balance sheet. You are done. It ends there. With the exception of if you see it in the trial balance. So I'm done. This it's always in the footnote. Ideally, it's in the footnote. They'll give it to you in the footnote, the additional information that the company's tax rate. The examiner will give you that, will tell that, oh, the tax provided for the year was 40,000, that's all. So take the 40,000, add it to the income tax expense, and that is here. Come and add it here. Second, add it to your current liabilities. I'm done. However, if it's in the trial balance, just add it to your current tax or add it to tax expense. It ends there. This is in a footnote. If it's in a footnote, however, if it is in a trial balance, if it's in a trial balance, only one treatment, add to tax expense. It means you are debiting P&L. It ends there. Full stop. We are done. So on that note, I'm done with this. No issue again. Nothing else. You must worry. I'm done. It's very simple. Actually simple. Now let me move on to the next section. That would be the under or over. I personally call it tax reconciliation statement. Okay, so if it's in the trial balance, it only appears at the income tax expense only. That's why I've used the only 2 times. Only. So in the trial balance, it doesn't call for 2 treatments. So if it's in the trial balance, you only add. So you add the word only to it, 1 treatment. Then you know that all the items in the trial balance must appear once. However, all the items, most of the items in the footnotes normally appear twice. So that is all about this. Agreed. And then we move on with the game. All right, so this is very clear. Now let's go to the next one. And as soon as we are done with IAS 12 entirely. So let's go to under or over tax provision. You see, always the current year tax is a provision, not actual. You see, the current year tax is a provision, not actual. So at the end of the day, there's always a likelihood. There's always a likelihood that the tax that you will provide in your books will always be different from what the taxman will also state as your actual tax liability. So at the end of the day, as a very good accountant, why can't you reconcile the difference between what the taxman said is your actual tax and what the accountant also said is their tax liability? Don't forget that the lens in which the accountant used to calculate the tax is different from the lens the taxman also used. The accountant used the lens made up of IFRSs, while the taxman also used a lens made up of what? Local tax laws. So definitely, they will never produce the same answer. So the under or over, I call it a tax reconciliation statement between what the accountant provided and what the taxman also agreed on. So let's go. So the computation is like this. You always compare two items. So you compare the tax provided, so much, and we normally say agreed. Agreed or final tax or tax paid. The final one, not the installment. So the difference represents under or over. Let me give you a typical example. Imagine we provided a tax of $3,200 in our account last year. Please, always for last year. It's always for last year. We can only reconcile last year's tax in this year's account. Take notice. We can only reconcile last year's tax in our report. We cannot reconcile this year's one because we are now even calculating this year in our account. Why do we make a provision? Let me make things clear for you. Let me ask a very practical question. Now, this is my humble question. When accountant is preparing financials and he reads the tax aspect, he's supposed to wait for GRA or the tax authority to furnish the right tax that he must pay so that he can add it to the financials. So the financial become what? Accurate, faithful, no massage, no problem. The same financial statement, the tax authority also waiting for it so they can also determine the right tax. So then all of us are waiting for the other party. Then that is why IAS 12 was released so that the accountant can use IAS 12 to do something, to represent something for the meantime. So that right after he submits it, and then next year when the real tax is pronounced, they can now amend things. They can now reconcile things. So always we make the provision first, and then we move on with the game. That is it. Now, you see, in Ghana, for instance, not even in Ghana, all tax authorities, they are the smart institutions. Yes, they are very smart. You see, tax man will not allow you to credit the tax for long. So when the year starts, they ask you to do what you call provisional assessment. You assess yourself to tax, and you start making payment, installment. So that at the end of the year, when they pronounce your final tax, you don't scratch your head, I don't have money. No. You start making product payments for those that in the tax section are of this. We're not interested in that, no. We're interested in the reconciliation. So imagine we make a provision of $3,200. But the tax authority, after examining our financials, they say, no way, $3,000 is not the right tax. The actual tax we have to pay have to be $4,500. So what? So here, have we under-provided? Please, the word is under-provided or over-provided. So have we under-provided or over-provided? Which is which? The tax that we provide in our account, $3,200. But the taxman said the right tax should be $4,500. So have we provided more or less? Will it be more or less? Of course, this will be under. Because we provided less. So by 1,300. So this is an under by 1,003. So in effect, when we prepare the financials, we have to key in 1,003 here. And then we are going to add, because under you add. We are adding because last year's tax, we could not, in fact, it was short by 1,003. So what do? This year, we have to just add to this year's as an expense. What if the unusual happen? Like that is will happen. That the tax liability that we provided is 3,002. The taxman said that it is not true. Our actual tax have to be 2,000. So what? $2,000. Okay. Then we have over provided by what? 1,200. So it means the last year tax, we provided much more by 1,002. So this year, wouldn't it be a credit for us? Of course, it will be a credit for us. So take notice that over tax provision is a credit to the entity. And that is why it is reducing our income tax expense here for the year. It's a credit, so it must go in a long run to reduce our tax liability. I am done. Again, let me give in the trial balance, with a trial balance, when I give you a trial balance, if you see current year tax, if you see current year tax at the debit side, it represents under tax provision. If you see under tax what? Provision. The same way, if you see it under the credit side, it is called over tax provision. Over. Copy that. I'm done. If you have a question, you ask. I'm done with under and over. I'm now going to deferred tax. Is the subject matter of tonight section. Subject matter. So that is all about under or over. Either it will be in the footnote or it will be the trial balance, and that's the treatment of it. And under and over, you only have to appear here. It appears here. It does not go anywhere again. So only this side, but you have to bring it. Now let's go to deferred tax. Deferred tax. Deferred tax. So we'll go to deferred tax. All right, so let's go straight to the deferred tax and move on with the game. So today, 2 standard gone. Our next meeting, we have to do IAS 16 and 40. 16 and 40 in our next meeting. And thereafter, we are going gradual basis. Now let's go to deferred tax. This is where you have to take notice of. It's a bit dicey. It's a bit dicey. Please, everything we are doing here, target professional consultants have question solving series. Every Friday, we will solve questions on that, so don't exempt yourself from coming Friday. However, if you cannot wait for us on Friday, it is allowed. Yes, what you can do is that, please log on to our platform. Log on to our platform, that is YouTube platform. We have specialized question solving. We have solved a lot of questions there. So once we are doing tutorials for now, all what I expect from you is that, so let's just imagine you go to this. It says for target professional consults. Now, go to the playlist. So I just want to show you how you can get this question solving. For those who want to see how we solve questions under each of the standard, we've done it. Go to the YouTube there, search for target professional consult. As soon as it arrives, first thing you have to do is to subscribe. Then you turn on the notification button. Then you share it to 5 of your good friends. You are done. Come back. Click on the playlist and select financial reporting like this. Wait for a while. Everything will come clear. Happy yourself. Now we are doing IAS 12. 5 videos in IAS 12. 5. It's here. 5. Forgive us. The sound and the picture quality wasn't too advanced like what you are enjoying now. So now click on that one like this. All the videos will pop up. So come here, question solving on IAS 12. Summary section. There's 2 questions solving. Oh, there's even examination questions. with solution. Oh, all these are available. What a wow. So just go through it. Happy yourself. All these are ICA, ACCA, SEMA selected questions. Then we have what? Solved. So please take notice and go through this for us. Yes. This video is doing magic. This IAS 12, I don't know. I think I issued that one at dawn on the local board. So you can see the write-up on the local board. So that is that. Moving from Ghana, you shall be preparing the account for let's say 20. So take notice of that. And you move with the game, please. So this is where you can get all the questions to solve. So I've shown you where you can get your question solved one. The same way we've done IAS 2 and IAS 8. IAS 8, we have 6 videos. It includes question solving. So this is a full IAS 8. It's here. All the videos are here. There's one that is making a lot of people like the first one. You can see that one is about close to 7K views. People like that one, please. I don't know why they like it. And then question solving. Another examination question solving. So already there's question solving, there's examination questions. All of them are for you. So please, IAS 2 is also there. All these are free, virtually free. It's because Target Professional Consult know that you will watch and it will help you. That is why we've done it. So please go through this and you are free to go. IAS is also there waiting for you. And then that is all. All the standards are here. Only few standards that are not here. Only few standards that are not here. And then we are free to go. Fine. My own video too, you are doing advertising. So that's all. And then we are free to go. We can't wait for these people. We can't wait for the advert. We cannot wait for the advert. Let's continue. So please go there, happy yourself, get everything clear. Even if you go, you're looking for a particular video, it's not there. Some of the videos you can't find it, yes, intentionally. It's under private mode. So you tell that Target, I need a video on how to do this. Give me some few minutes. I'll send you the link. You happy yourself. I need this particular video. Even if it's not there, I'll show you where you can get that video. Yes. Because some of them, when you search, you can't find it. It's under private mode. So we'll share that one with you personally. And then let's continue with my deferred tax. Now, happy yourself for the deferred tax. Deferred tax, let me explain how deferred tax are right. Our year ends somewhere December 2022. We are preparing 2022 financial statements. This is how it works. Something will happen either in the current year or the previous year up to here. So either it happened in 2022 or 2021 and then 2020 and beyond. So that 2021, 2022. So here the condition is that either previous periods or current period. That's the condition. So get the condition clear. So me writing a lot of years is not important. Know that previous years or current year. That's first condition. Transaction will take place, something will take place here. However, the tax effect is in the future date. So transaction will occur today or transaction will occur in the current year or the previous year, but the tax effect will take place next year or future. That is all. It will create a deferred tax. So you, I shall not fall. Yes. Transaction and event that has taken place in the previous years or the current year, but the tax effect is in the future date. It creates deferred tax. So typical example, follow this example and you are free to go. So you can get it clear. Let's just assume that in the current year, maybe up to these dates, a customer walked to our shop and he purchased something, credit sales of, let's say, $40,000. And the customer promised us that target professional consult. Exactly 2 years, I'll come and pay this money. Exactly 2 years. So exactly 2 years will be when? December 2023 is 1 year. 2023 is 1 year. So exactly 2 years will be which year? 2 years. That will be 2024 December. So that is the payment. You see, the tax authority most often or largely, they will only tax when the customer brings the money. So they don't tax when you have made a credit sales, because when they tax you, it will not fulfill one of the maxims or one of the principles of taxation, the ability to pay. Because the ability to pay won't be there. Because the guy did not receive money. Even though the guy have made a sale, money is not in the guy's hands. So, which money again do you expect the taxpayer to use to pay for that tax? So the goods that they have sold on credit, the tax effect will only take place when and only when the customer brings the money. What if the customer ran away with the money? That is why if you can provide evidence, enough evidence, the taxman will never tax you on a bad debt. That if they have evidence, if it is specific. So take notice of that. So in other language, anytime transaction takes place, but the tax effects in the future, it's going to defer tax. So here, even though we've made a credit sale in a current year, the tax will be somewhere here. So give me the tax rate. So transaction took place December 2022. A credit sales of $40,000. Let's just assume that that's the transaction date. Target professional consult. Target professional consult is in 25 tax brackets. So this is the reporting date. Our tax rate is 25. Who can calculate the tax liability for me? The customer will pay in December 2024. That is where the customer will pay. And that's where the tax, what's the tax liability? If the tax rate is 25% tax rate, target professional consult will be how much? The tax liability will be You can calculate and then share. Tax liability will be 25% of 40,000. How much? That will be $10,000, right? Into bracket 25% of. So tax of so 10,000 tax liability. So the taxman will wait. The day the customer brings the money, and taxman says, hello, don't forget us, oh, don't forget us. That we are also at the corner, waiting for our money. Now, this IAS of deferred tax is on one of the conceptual framework principle. It's on prudence. In accounting, if you know that there's a harm coming towards you, you make adequate provision. That's what prudence is saying. So as a prudent accountant, you know that certain transaction has taken place already, but it will let you pay tax high or less in the near future. So why can't you make a provision towards it? So we are making a provision towards such tax. Even though transaction today causes that particular provision. So the question is this. Okay, something's of course my issue. Good. I've done it. Now let's go. So now, exactly 2024. So why can't we make a provision? So you see, it is the taxes that we're supposed to pay today, but due to the tax authorities' law, it's in the future. It has been deferred to the future period. So it's the taxes on today's transaction, which has been deferred to the future period. But we are bringing it back. We are making provision towards this 10,000. So we have to make a provision. So in this year's account, why can't we make a provision of 10,000 so that in the year 2024, when the tax man asks us to come and pay the 10,000, we will not be scratching our head that this money there that we are paying. See, if they give you the money, you spend the money, and later on they ask you to come and pay the tax on it. It's some way. So prudent accountants make provision. So that's all. So if I should summarize deferred tax for you, deferred tax is just an estimated tax consequence. Estimated tax consequence on transactions and events which takes place in the previous period or the current year. Full stop. So anytime we are estimating the tax consequence, the tax effect of transactions which has already occurred in the previous period or the current period, then it means we are conducting, estimating what deferred tax. That's all. So that's what we can say is the definition of deferred tax. So take notice, and deferred tax is an accounting measure, not a legal measure. I always say this. So deferred tax is an estimated future tax consequence of transactions and events recognized in the financial statements of the current and the previous period. So put some few points down, okay? Put some few points down. So from this, from the above, from the above, comma, we can say that deferred tax. Please, when they ask, don't come and tell us that it's the tax that we have deferred to the future period. Don't say it's tax that we're supposed to pay today and we have deferred to the future. Please, you say that. We'll not take it easy with you. That's that. Is the estimated future tax consequence. Estimated. So deferred tax is the estimated future tax consequence. Of transactions and events recognized in the financial statement of the current and previous period. That's all. Of the current and the previous periods. I'm done. So that's the definition for deferred tax. What caused deferred tax? Please take notice of what caused deferred tax and the treatment. So we are at the tail end of the story. But don't forget to go through the question solving stage. And we move. Now, there are some two types of profit. There's some two. We have what you call accounting profit. Can't tell me the difference between an accounting profit and taxable profit. Accounting profit and what? Taxable profit. Can you tell me the two? The difference. Let me explain it so that I can move fast. When you say accounting profit and taxable profit, accounting profit, as the name suggests, accountant's profit, is a profit before tax. Determined in accounting books. So it's a profit before tax determined in accounting books or by the company using the IFRS. So accounting profit, we use IFRS to determine that. So that is what all the profit you see in the company's financial statement, their profit before tax is called accounting profit. So any published financial statement, their profit before tax is called what? Accounting profit. Now, taxable profit. I call it taxman's profit. Is a tax, is a profit determined by the tax authorities after careful examination of the entity's financials using the local tax law. Using the local tax law, in which the entity's income tax liability will be levied on. So the income tax liability of an entity is always calculated on the taxable profit. So take note, I'm done with the taxable profit. What do you think will be the difference? One using what? IFRS lenses. The other one uses what? Local tax lenses. to look at it. So definitely it will be different. Yes, the profit will be the same. What caused the difference? What do you think will cause the difference? The difference are grouped into two. And you see, the difference can be grouped into two. We have the permanent difference. Permanent difference. Then we have the temporal difference. So take notice. Permanent difference and temporal difference. So take notice. So let's go to temporarily different. Temporal difference. One of these causes deferred tax. Good. Let me start with a permanent difference. When you say permanent difference, it's one-off transaction that is acceptable by one party and rejected by the other. When I say one party, I'm talking about the accountant and then the taxman. Permanent difference, that one is a one-off transaction. It always or mostly occur in one accounting period. So it doesn't repeat itself. It's not something, not that doesn't repeat. It's not something that is an account carry forward. No. It is not an account that remains in the books for some time. No. It's a one-off transaction that the taxman rejects. At the same time, the accountant accepts. Or the taxman accepts, but the accountant rejects. That's all. So a typical example. In almost all the tax authorities on this earth, I don't know whether they normally go for meetings somewhere. Almost all the tax authorities on this earth, they don't communicate like on certain issues, but their minds are almost the same. Yes. So something like entertainment expense, they don't like it. Entertainment expense is a very good expenditure that you always see among accounting records. But per the tax laws, entertainment expenses are not tax deductible. They are not part of an expenses that the taxman will agree. So this, it will always cause what you call a permanent difference. And then it's one-off. That's all. And some aspect of donation, not all donation, the taxman will also agree. So all the disallowable expenses create depreciation. All these are what? Examples of permanent difference. One-off. Depreciation won't be one-off. So let me move it from to the temporal. Now let's move on to temporal difference. Please, permanent difference does not cause deferred tax. Instead, it's the temporal difference that causes deferred tax. Now let's go. Let's go to temporal difference. What is temporal difference? And then that's all. Temporal difference is it with a temporal difference. When accountants see mango, it will still be a mango. Taxman also sees that mango. Good. But with a temporal difference. Okay, so I think I have to take someone's have to take the temporal, the permanent difference again. Permanent difference is just a one-off transaction. One-off transaction. So one-off transactions between the tax authorities and then the reporting entity. So there was either the taxman accepts, accountant rejects, or accountant accepts, taxman rejects. Just one off. One-off in a sense that it only occurs in a particular period, just one particular period. That's all. Just one particular period. It occurs just 1 year. It does not repeat itself. So it's not something that it repeats itself. That's all. Good. And it does not cause deferred tax, please. Temporal difference, permanent difference has no root or has no cause in when deferred tax. Now let's go to temporal difference. Temporal difference is the one that causes deferred tax. What is temporal difference? I was explaining. You see, entertainment expense, accountants see it as a valid expense. That's why you always include it in his financials. But the taxman will see entertainment expense as what? Invalid expense, because it is not wholly, exclusively, or necessarily incurred. That's what the taxman will say. But trust me, certain things, when the taxman sees it, he will never deny it. Like the company's building. Can a taxman see a building as a stones? Can a taxman see the company's car, the company's motor vehicles as a bicycle or pragya? No. You always see the motor vehicles as vehicles, building as building. But the timing is different. With the temporal difference, the time that accountants will see that this is a building is different from the time or the day or the year that the taxman also said that this is also an asset. And even the useful life, it's practically different. So take notice of that. So typical example, accountants will assume that building will have, let's say, 50 years. Taxman say, no way. Maximum we can give you is 10 years. So you see that this one, the difference is temporal. So after 10 years, the building vanished from the taxman's records. Then after 50 years, the building also vanished from where? The entity's record. So this difference is just a temporal. After certain years of time, everything vanished. So that's to say temporal difference. So temporal difference, it only exists when all of them see the item as one, but the timing is different. So for example, if this device, this mobile phone, if the company buys now and record mobile phone, at what time would the taxman see this as a mobile phone? At what time would the taxman see this? So if the timing is different, that the day that the entity recorded as mobile phone is different from the day that the taxman also see this as a mobile phone for the entity. Again, the amount that the entity will put in, the taxman will not agree on the same amount. Certain amount that the entity will add as a valid cost of this mobile phone, the taxman will say, no way, I will never agree. Item number 3, certain deductions that the entity will subtract, like depreciation from the use of this phone or this asset to the entity. The taxman will not agree to that deduction. The taxman will have his own different method of deduction. They call it capital allowance. So at the end of the day, this creates difference between the same phone which has been recorded in the entity's records and the tax records. So as soon as you file your tax, the tax authorities will prepare another financial statement with your records, and they will value the things using their own or the local tax laws. They don't use the IFRS. So at the end of the day, the question is, the timing is what? Different. And then the value and the amount. That's all. So that's all about temporal difference. And it's the one that causes deferred tax. And this is why I spend much time on temporal difference, because it's the one that causes deferred tax. Because you see, at the end of the day, Anytime you claim that you have an asset, but the taxman says you don't have an asset, it causes deferred tax. Anytime the taxman also tell that you have an asset, if you say I don't have an asset, it creates deferred tax. So let's go straight to the definition of temporal difference. So temporal difference per IAS 12 is the difference between the current amount of an asset or a liability in a financial position and its what? Tax base. So let me write some few definition here for you. Tell examiner. This one, know the definition for temporal difference. So temporal difference is the difference between the current amount of assets, the current amount of asset or liability, assets or liability recorded in the financial statement and they are tax based. Tax base is an amount recorded for tax purposes. Amount recorded for tax purposes. I'm almost getting to the latter part, tax purposes. So for tax purposes, what should be the value? If it's not the same as how the accountant also value it, forget it. It will always create deferred tax. And they will be always different because the accountants use IFRS, taxman use local tax law. So at the end of the day, there will be differences in valuing asset and liabilities. The mindset and then the eye that the taxman uses to value asset and liability is different from the mindsets. And then what? And then the eye that the other person also uses. At the end of the day, it's always bound to create a difference. And that difference is temporal. Asset and liability is not forever. You will always get rid of them. So as long as they move from your balance sheet, it doesn't create any difference again. So that is what we are trying to see. So let me give a typical example. Let's try to examine something small here. So just imagine here, we have an asset. Give me a typical example. So there are two things that are called deferred tax. It's either asset or liability. So let me start, let's say assets. Give me an example of an asset. To be precise, non-current asset. This is the current amount. Please, the current amount is also known as accounting base or book value. You also have the tax base. Tax base simple means for tax purposes. An amount for tax purpose. That's the tax based. Tax base of an asset for tax purposes. Tax based. Dollars. Good. Now let's just assume there's an asset, building. Typical example is building. The current amount of the building, current amount, please, when we mention current amount, I presume that most or everyone is aware how to calculate current amount. Cost minus accumulated depreciation. If there's any impairment, you subtract. Good. So here, current amount, let's say $450 of $150 million. But the tax base is somewhere $300 million. What's the temporal difference? Now the temporal difference is what? It's $150 million. This is called temporal or temporal difference. That's all. 115 million. 115 million. That's all. And this creates deferred tax. It creates a deferred tax. So at the end of the day, to get a deferred tax, this is equal to the temporal difference times the tax rate. That's all. So if I multiply this by, let's say, 25%, it be the tax rate, I get my deferred tax provision. So take notice, we barely have 9 to 10 minutes more. Let's go. Now, there are types of deferred tax or the temporal difference. Anytime the item in question is an asset and the current amount is greater than the tax base, the temporal difference, which is 100. I wish I could do this somewhere. Okay, so we should put the analysis. Okay. Let me give you more examples before I come to them. If the item is building, which is an asset, current amount is 450, tax base is 300. The difference here. So the difference, which is 150 million, it's called temporal difference. Then the deferred tax will be deferred tax, equivalent deferred tax. It's always equal to the tax rate. Tax rate times the temporal difference. So in this case, let's just assume that the tax rate is 25. Times $150 you got $150 million. Who can do the computation? 25 times $150 million. What we get? 25 million times $150 million. Okay, so if you multiply 25, should that be done 25 times $150? That'll be $37.5 million. $37.5 million. That's the deferred tax. I'm done. Now let me do the last analysis, and that's all for IAS stuff. This side is a bit complicated. So let me do another analysis again. I'll do it here. So let me do it here, somewhere here. Now, let me put current amount here. Let me put tax base here. Let me put temporal difference here. So if the item is an asset, let's say building, and the current amount is, let's say, 600, tax base is 500. Who can tell me the temporal difference? What will be the temporal difference? Obviously 200. If the carrying amount, there are two conditions here. If the item in question is an asset, number one, and number two, if the carrying amount is greater than the tax base, the temporal difference is called taxable temporal difference. Taxable temporal difference. It means that in the near future, they will tax the company well. It means that in the near future, the company will be taxed. And please, in the near future, if they are going to tax you, will it be a liability or is an asset to you? Say the truth. Transaction has happened right now. And in the near future, the tax authority have informed you that you know for sure that this transaction, it will increase your tax liability. Will it be a liability to you or it's an asset to you? Obviously, the answer is one. It will be what? A liability. So always taxable temporal difference is always a deferred tax liability. When you start the computation, to be clear, so this is a non-current liability. The reverse is true. So this is into bracket non-current liability. Now, what if the current amount rather is less than, let's say 700 versus 800? Temporal difference is 100. This one is called deductive. It is called deductive temporal difference. This is called non-current asset. It's a deferred tax asset. So in the near future, the tax man will deduct, will not tax you. It will reduce your tax burden. In that case, it becomes what? A non-current asset. So that transaction will reduce your tax burden. That's a non-current asset. That's all. That's a non-current asset. So at the end of the day, check which one is higher. And is it an asset or is it a liability? Everything done here, the reverse is true for liability. So who can do the liability for me? So let's say current amount, tax base, temporal different. And it's a liability. Give me an example, loan. Current amount of loan is $45,000, but the tax base is just $40,000. Will it be taxable? There's a temporal difference of 5,000. Will it be taxable or deductible? You see, everything about asset directly opposite will be for what? Liability. So over here, it will not be taxable, it will be deductible. So this will be deductible. Deductible. Then the next one is if it is this $50,000 is more, less than $60,000, that will be $10,000. This rather is taxable. Please just learn one and then apply the remaining one. So this is how you calculate deferred tax. Please, it's a bit dicey, a little bit dicey, slippery. So what our advice is that right after the section, go through the question solving more and you are free to go. At the end of the day, let me do the final illustration and then we are done. So take notice about deferred tax computation. So it means that you must calculate the carrying amount and tax base. So in exams, know how to calculate carrying amount. Know how to calculate carrying amount, know how to do all these computations and you are fine. Because if you know how to calculate carrying amount and tax base, you can easily do the temporal difference. And don't forget that deferred tax is the tax rate multiplied by what? The temporal difference. So you getting the temporal difference not enough. Proceed to multiply the tax rate. And the final one, the workings. You must do extra workings for deferred tax. So workings, so write the deferred tax movement. So this is the final workings you do. So I'm summarizing everything here so far. Deferred tax account or movement. First is an account. So you can start from the open balance. Right here, balance brought down. That's the open balance. Usually from the trial balance. If it's for the first time, it will be 0. Leave enough space. Right here, closing balance. Balance carry down. And this always in the footnote. You don't want to line it. This is the one that you calculate. This is the one you calculate by finding the temporal difference times the tax rate. That's all. So the difference between this and this is the movement. We call it P&L into bracket income tax expense. So this is the deferred tax movement. It's a balancing figure. And this is what we normally come and place it here. Good. So this particular figure here is what we've calculated now. So the movement comes here. The movement. So this is the movement, the balancing figure from the deferred tax workings. So deferred tax workings. And always the closing balance of the deferred tax. It can be a current liability. So this one, it can be a non-current liability or non-current asset, depending on the type of the temporal difference. This is taxable. If it is taxable, then we have deductible. Good. If it is taxable, it's a non-current liability. If it is deductible, it becomes non-current asset. That's all for the game. So at the end of the day, we are done with deferred tax. Everything you need to know about it. Take time, go through it. And if there are questions, you let me have them before I end the section. At least you've done what we've done, 2 of the standards. Very important. Very important standards. So I hope during the question solving stage, I'll see you again on the question solving. This one, we're only building principles. We're making the principle clearer. And then that's all. So any question for me before I close the chapter of today's edition? All right, so this is ICA Ghana March 2023 exams, last 2 sitting. And they were asked to compute the company deferred tax liability as of 31st December 2021. So what you need to do is get the current amount of the assets. The assets can be many. Get their tax base. Multiply by 30%. You are done. Nothing else, nothing more. 6 solid marks. So during the question solving stage, we have to look at it with eagle eye. Or you can take a screenshot of it, put it down for solving. If you solve it, you can share with me. I'll go to the calculate deferred tax. You can screenshot this side nicely like that. Good. The same year, the broad deferred tax for the final level corporate reporting. Let's go to the same sitting, everything the same, corporate reporting. See how you also had it. So take notice of that. It was the question 3. They had it in the second question. Assume that Sedio has sufficient taxable future, receive tax relief. So it was tax for any inventory loss. Sedio. Sedio PLC import wheat from Ukraine. And you get this, that. Recommend with brief explanation the correct financial reporting treatment. So over here, they will not ask you to do calculation. No, for final level, like we'll ask you to recommend the treatment because there are other issues that will pop up, not necessarily giving you the deferred tax computation. But here, some of these transactions will create deferred tax. So you have to also elaborate on that. If any of them will create deferred tax, you go further. So here we are not telling you the only one-sided, just deferred tax as you saw. No, here will tell you several issues that you have to tell us. Again, here, good, this question, the company's tax rate as at the year end was 20%, but a revised rate, 25% was introduced in 2018. So you see, which of the tax rates you have to use? Either you have to use the current tax rate or tax rate subsequently enacted by Parliament, not rumor. So campaign promises on tax rates should not be used in accounting. We are begging you. So here you have to use the current tax rate or the rate that is subsequently enacted. So here the final level, the examiner is testing all this, which is the best rate. Good. That is it. I also have other questions. There are more questions. I also have a lot of them for you here. So, okay. I just remembered that my question set was ready. Yes, it's true. I have questions for you. So first question of the day will be from here. Yes, all these questions are there in the material for you. Good. Let me go to tutorial questions. They will give you properties, give you the tax base, calculate the deferred tax provision for as at 31st December 2015 and the rest. So all these questions are for you. When we start the question solving, they are abundant. There are a lot of them. So on that note, we have successfully completed the very first 4 standard IFRS. We are moving on. And most of the level 3 students don't do these standards. So anytime they need it in their explanation, it becomes a problem. It becomes a problem. Anytime they need it, so imagine this the final level question, corporate reporting, IC asks them, which has issue of 2 different tax rates and sufficient taxable profit. The tax aspect explanation will be very little. Very little. Yes, be very little. In a sense that many might not be able to appreciate the tax issues. Yes, I have other set of questions that are also going for you, because I really got those materials. So please, I'll share them with you in the meantime. So that note, I'll end here and you will continue to give for me. So any IAS stuff have been dealt with, it's computation. What left is the computation. So you have to now take another time to solve questions with you so that you be clear. And for those who want to solve the question out of time, do not hesitate to use the lecture videos. If you go to YouTube, our playlist, our channel there, please, there was more than enough questions we solved. All of them are standard professional questions. ACCA, SIMA, ICA, Ghana questions we solved over there. So go there and happy yourself. Any standard you don't understand, please don't wait before when you have critical interviews before you're going to search for these standards. Now that you are free, go there, start. Let's say 1 week, one standard. So this week, let me learn everything about IAS 8. First 3 hours, next 3 hours, you are free to go. You are done with IAS. Another week, 2. So give yourself a year, all the 45 standards through our free lecture videos. You get everything clear. Don't go and pay. Don't go and pay. Get it clear. And then you are free to go. But please, for those who want to pay, if you still want to pay, I can give you an account number to pay. Yes, the thing is free. But if you still want to pay or support, grow the system so that we can advance the system to no problem. Account numbers are ready. Yes, if you contact us privately, we will share those numbers with you and you pay everything through. Thank you. All right, so any question for me before we close the chapter of today's edition? Thank you very much for coming. And our next meeting, we have to tackle IAS 16 and 40, PP and property, PP, and then the investment property. Yes, those 2 standards have to be dealt with. Apart from those 2 standards, the rest of the standards are very super. We'll be doing standard like IFRS 5, non-current asset held for sale and discontinued operation. IAS 37 provisions, 38 intangible assets. We'll do IFRS 15 revenue, IFRS 16 leases. You can't afford to miss any part. Likewise, we'll do IFRS 3 business combination, IFRS 2 share-based payment, IAS 19 employee benefits, IAS 21 price level changes or foreign exchange transactions. We'll do all the standards. Don't forget, when I will group them into 3 for you. We have the liability standard, asset standard, and performance standards. I'll group them. And how each of the professional exams select their questions. So every examination dies at least 1 asset standard, 1 liability standard, and 1 performance standard. We are good to go. So after everything, I'll regroup these standards for you that these are the asset standard, these are the liability standard, these are what? The performance standards too. So that you know that at least before you sit for any professional exams, you've done 5 asset standard, 5 liability standard, and about 3 performance standards. You are free to go. Now you can write any professional exams in which IFRS are being tested. You can still write because you've done the needful. So on that note, let me end it here. Continue again, God willing, tomorrow. Tomorrow we are doing strategic case study, still on environmental analysis, and we move on with the game. If you have a question, kindly ask before I close this chapter. If you are not subscribed, kindly subscribe to the channel. And if you want to support you, don't worry. Thank God, Target Professional Consult, we have gotten up to, we are getting close to 2,700 subscriptions. So it means that you can still place your advert with us. Yes, you can still place your business promotion with us and you get the large content, large audience. Good. So thank you very much. Any question for me before I close the chapter of today's edition? If you do have a question, can you put them in the comment section?